Hey everyone, welcome back to the Finance Hub. Today we're diving into a crucial topic, 15 money habits keeping you poor. These habits might seem harmless at first, but they can have a significant impact on your financial health over time. By recognizing and changing these habits, you can take control of your finances and build a more secure future. Before we jump into the list, let me know in the comments if any of these habits sound familiar to you or if there are any other money habits you think we should talk about in future videos. Now, without further ado, let's get started with the first money habit that's holding you back. 1. Living beyond your means. Our first habit is living beyond your means. It's easy to swipe that credit card, but if you're spending more than you earn, you're setting yourself up for financial disaster. Many of us fall into the trap of wanting the latest gadgets, designer clothes, or dining out frequently without considering the long-term consequences. When you consistently spend more than you make, you start accumulating debt. This debt comes with interest, making it even harder to pay off in the future. It becomes a vicious cycle where you're constantly playing catch-up, and your financial goals remain out of reach. To break this habit, start by assessing your spending habits. Track every expense for a month and categorize them. Identify areas where you can cut back and create a realistic budget that allows you to live within your means. Remember, it's not about depriving yourself, but about making smarter choices that align with your financial goals. 2. Not having a budget. Not having a budget is like trying to drive blindfolded. You need a clear picture of your income and expenses to manage your money effectively. Without a budget, it's easy to lose track of where your money is going and overspend on non-essential items, leading to financial stress and debt. A budget acts as a roadmap for your finances. It helps you allocate your money towards essential expenses like rent, utilities, and groceries, while also setting aside funds for savings and investments. By planning ahead, you can avoid unnecessary expenses and make informed financial decisions that support your long-term goals. Creating a budget doesn't have to be complicated. Start by listing your monthly income and fixed expenses. Then track your variable expenses and identify areas where you can cut back. Use budgeting tools or apps to simplify the process and keep you on track. Regularly review and adjust your budget to ensure it reflects your current financial situation and goals. Remember, a budget is a powerful tool that gives you control over your finances and helps you build a secure future. 3. Impulse buying. Impulse buying can drain your bank account fast. It's that sudden urge to purchase something unplanned, often triggered by emotions or attractive marketing. While it might feel satisfying in the moment, these spontaneous purchases can add up quickly and wreak havoc on your budget. Impulse buys are usually non-essential items that we don't actually need. Think about those random gadgets, trendy clothes, or the latest tech that you bought on a whim. These items often end up collecting dust or cluttering your home, serving as a constant reminder of wasted money. Over time, these small, seemingly harmless expenses can significantly impact your financial health, leaving less money for important goals like saving, investing, or paying off debt. To combat impulse buying, practice mindful spending. Next time you feel the urge to buy something, give yourself a 24-hour cooling-off period. This pause can help you determine whether the purchase is truly necessary or just a fleeting desire. Additionally, make a shopping list and stick to it. Avoid shopping when you're emotional and unsubscribe from promotional emails that tempt you with sales and discounts. By being more intentional with your purchases, you can save money and make better financial decisions. 4. Neglecting an emergency fund. Without an emergency fund, unexpected expenses can throw you into debt. Life is full of surprises, and not all of them are pleasant. Whether it's a car breakdown, medical bills, or sudden job loss, emergencies can happen when you least expect them. Without a financial cushion, these unexpected events can lead to high-interest debt as you scramble to cover costs. An emergency fund acts as a financial safety net, providing peace of mind and security. It allows you to handle unforeseen expenses without disrupting your budget or resorting to credit cards and loans. This fund is crucial for maintaining financial stability and preventing minor setbacks from becoming major financial crises. Aim to save at least 3 to 6 months worth of living expenses in your emergency fund. Start small if necessary, setting aside a portion of each paycheck until you reach your goal. Keep this money in a separate, easily accessible account, such as a high-yield savings account. Avoid dipping into it for non-emergencies. It should be reserved for true financial emergencies. By prioritizing your emergency fund, you'll be better prepared to handle whatever life throws your way. 5. Paying only the minimum on credit cards. Paying only the minimum on your credit card keeps you in debt longer and costs you more in interest. When you only make the minimum payment, you're barely making a dent in your principal balance. Instead, most of your payment goes toward interest, meaning your debt grows slowly over time, and you end up paying significantly more than you originally spent. Credit card companies often highlight the minimum payment option because it benefits them by generating more interest revenue. However, it creates a debt trap for you. For instance, if you have a balance of $5,000 with an interest rate of 18% and you only pay the minimum, it could take over 20 years to pay off the debt and cost you thousands of dollars in interest. To break this cycle, aim to pay off your balance in full each month. If that's not possible, pay as much above the minimum as you can to reduce your principal balance faster and minimize interest charges. Additionally, consider consolidating your debt with a lower interest loan or balance transfer card to reduce the overall interest burden. By prioritizing larger payments, you can free yourself from the shackles of credit card debt and save money in the long run. 6. Not investing. Not investing means missing out on potential growth. When you leave your money sitting in a regular savings account, it doesn't grow much due to low interest rates. Investing, on the other hand, allows your money to work for you and can significantly increase your wealth over time. One of the most powerful aspects of investing is compound interest, where the returns you earn on your investments generate their own returns. This means your money grows exponentially, especially the longer you leave it invested. Even small, regular investments can add up to a substantial amount over the years, helping you achieve financial goals like buying a home, funding education, or enjoying a comfortable retirement. Start with what you can afford, even if it's just a small amount. Explore various investment options such as stocks, bonds, mutual funds, and real estate to diversify your portfolio and manage risk. Take advantage of employer-sponsored retirement plans like 400 and ONCs, especially if they offer matching contributions. Educate yourself about investing and consider seeking advice from a financial advisor to create a strategy that aligns with your goals and risk tolerance. Remember, the sooner you start investing, the more time your money has to grow. 7. Ignoring financial education. Knowledge is power. Ignoring financial education means missing out on strategies that could help you save and grow your wealth. In today's complex financial landscape, understanding how money works is crucial for making informed decisions that can significantly impact your financial health. Many people avoid financial education because they find it intimidating or believe it's only for experts. However, gaining even a basic understanding of personal finance topics, such as budgeting, saving, investing, and debt management, can have a profound effect on your ability to achieve your financial goals. Knowledge empowers you to take control of your finances, avoid common pitfalls, and capitalize on opportunities to build wealth. To get started, dedicate time to learning about personal finance. Read books, listen to podcasts, watch educational videos, and follow reputable financial blogs. Engage in discussions with financially savvy friends or join online communities focused on financial literacy. Consider taking a course or attending workshops to deepen your understanding. Remember, the more you know, the better equipped you'll be to make decisions that benefit your financial future. Continually educating yourself ensures you stay updated with the latest financial strategies and trends. 8. Keeping up with the Joneses. Trying to keep up with others can lead to unnecessary spending. It's natural to compare ourselves to our peers, especially in a world where social status often seems tied to material possessions. Whether it's the latest gadgets, luxury cars, or extravagant vacations, the pressure to keep up with the Joneses can tempt us into spending beyond our means. However, financial decisions should be driven by your own goals and priorities, not by external expectations. Chasing after what others have can strain your finances and delay your own financial progress. It's important to remember that appearances can be deceiving, and not everyone who appears wealthy is financially secure. Instead of competing with others, focus on your own financial goals and values. Take time to define what financial success means to you, whether it's saving for a comfortable retirement, buying a home, or funding your children's education. Set realistic milestones and create a budget that aligns with your priorities. Celebrate your progress and achievements, regardless of how they compare to others. By staying true to your goals and avoiding unnecessary comparisons, you'll find greater satisfaction and financial peace of mind. 9. Overpaying for convenience. Convenience comes at a cost. In today's fast-paced world, we often opt for convenience without considering the financial implications. Whether it's dining out frequently, using delivery services, or taking ride shares instead of public transport, these conveniences can add up quickly and strain your budget. While these services save time, they often come with a premium price tag. Dining out regularly, for example, costs significantly more than cooking meals at home. Similarly, opting for delivery services instead of picking up items yourself can include service fees and tips that inflate your expenses. Even small conveniences like daily coffee runs or ordering takeout multiple times a week can drain your wallet over time. To save money, consider embracing more cost-effective alternatives. Cooking at home not only saves money but also allows you to control the ingredients and portion sizes. Use public transportation or carpooling to save on fuel and parking costs. Plan your errands efficiently to minimize unnecessary trips and consolidate tasks. By being mindful of where your money goes and making intentional choices to prioritize savings over convenience, you can free up funds for more meaningful financial goals. 10. Not tracking small expenses. Small expenses can add up faster than you think. It's easy to overlook the impact of daily purchases like morning coffee, snacks, or impulse buys. These seemingly insignificant expenses can accumulate over time and derail your budget without you even realizing it. Tracking your expenses is essential to understanding where your money is really going. It allows you to identify patterns, recognize unnecessary spending habits, and make informed decisions about where to cut back. When you track every penny, you gain clarity on your financial habits and can prioritize spending on what truly matters to you. Fortunately, technology makes it easier than ever to track your expenses. You can use apps, spreadsheets, or even pen and paper to record every expenditure. Categorize your expenses, such as groceries, dining out, entertainment, and utilities, to get a comprehensive view of your financial habits. Review your spending regularly to spot trends and adjust your budget accordingly. By being proactive about tracking small expenses, you can take control of your finances and make smarter financial choices that align with your long-term goals. 11. Failing to shop around. Whether it's groceries, insurance, or loans, failing to shop around can mean missing out on better deals. Many of us tend to stick with familiar brands or providers without realizing that cheaper or better options may be available elsewhere. This oversight can result in overspending and missed opportunities to save money. Comparing prices before making a purchase is a simple yet effective way to stretch your dollars further. For groceries, check out different stores in your area or explore online options that offer discounts or promotions. When it comes to insurance, get quotes from multiple providers to find the best coverage at the most competitive rates. Similarly, before taking out a loan or financing a purchase, compare interest rates, terms, and fees from different lenders to ensure you're getting the most favorable terms. Thanks to the internet, comparing prices has never been easier. Use price comparison websites, apps, or simply browse different retailers' websites to find the best deals. Don't forget to factor in additional costs like shipping fees or membership discounts that could impact your overall savings. By being proactive and investing a little time upfront to shop around, you can maximize your purchasing power and keep more money in your pocket. 12. Not having financial goals. Without clear financial goals, it's easy to waste money. When you don't have specific objectives to guide your spending and saving decisions, you may find yourself drifting aimlessly from one purchase to another without considering the long-term impact on your financial well-being. Setting financial goals provides direction and purpose to your money management efforts. Whether you're aiming to build an emergency fund, save for a down payment on a home, pay off debt, or invest for retirement, having clear objectives helps you prioritize your spending and stay disciplined in your financial decisions. Start by identifying both short-term and long-term financial goals. Short-term goals could include saving for a vacation, purchasing a new gadget, or paying off credit card debt within a year. Long-term goals might involve buying a home, funding your children's education, or achieving financial independence by a certain age. Break down these goals into actionable steps with realistic timelines and measurable milestones. Visual aids such as vision boards or financial planning sessions can help solidify your goals and keep you motivated. Regularly review your progress, celebrate your achievements, and adjust your goals as your priorities evolve. Having a roadmap for your financial journey not only encourages disciplined saving and spending habits, but also empowers you to make decisions that align with your aspirations for a secure financial future. 13. Paying high bank fees. Bank fees can sneak up on you and erode your savings without you even realizing it. From monthly maintenance fees to ATM withdrawal charges and overdraft fees, these costs can add up over time and eat into your hard-earned money. To avoid paying high bank fees, it's essential to be aware of the fee structures associated with your accounts. Many banks offer accounts with low or no fees, especially if you meet certain criteria such as maintaining a minimum balance or setting up direct deposits. Take the time to compare different bank accounts and read the fine print carefully before opening an account. Consider opting for online banks or credit unions, which often have lower fees compared to traditional brick-and-mortar banks. Online banks, in particular, may offer competitive interest rates on savings accounts and fewer fees for routine transactions. Additionally, take advantage of technology to manage your accounts efficiently and avoid unnecessary fees. Set up alerts for low balances, monitor your transactions regularly, and opt for electronic statements to reduce paper statement fees. By proactively managing your banking relationships and staying informed about fee structures, you can minimize unnecessary expenses and keep more of your money working for you. Remember, every dollar saved on fees is an extra dollar that can go toward achieving your financial goals. 14. Avoiding negotiation. Avoiding negotiation means you might be paying more than you need to. Many people shy away from negotiating because they fear rejection or feel uncomfortable discussing money. However, negotiating can be a powerful tool for saving money and getting the best value for your purchases, services, and even your salary. When it comes to everyday purchases, don't hesitate to ask for discounts, especially on big-ticket items or when buying in bulk. Many retailers are willing to negotiate, particularly if you're a loyal customer or if an item has been on the shelf for a while. Similarly, when signing up for services such as cable, internet, or insurance, inquire about promotions or loyalty discounts that may not be advertised. Negotiating your salary or freelance rates is also crucial for maximizing your income potential. Research industry standards, highlight your skills and achievements, and confidently discuss your value with employers or clients. Even a small increase in salary or fees can have a significant impact on your long-term financial stability. Remember, negotiation is a skill that improves with practice. Be polite, respectful, and prepared with information to support your request. Don't settle for the first offer. Be willing to walk away if necessary. By advocating for yourself and negotiating effectively, you can lower your expenses, increase your income, and ultimately improve your financial situation. 15. Not seeking professional advice. Sometimes you need expert help. Consulting a financial advisor can provide personalized advice to help you reach your financial goals. Many people hesitate to seek professional advice because they assume it's only for the wealthy or they feel they can manage their finances on their own. However, a financial advisor can offer valuable insights and strategies tailored to your unique financial situation. Whether you're planning for retirement, managing investments, saving for a major purchase like a home or education, or navigating complex financial decisions, a financial advisor can provide guidance and expertise. They can help you create a comprehensive financial plan based on your goals, risk tolerance, and time horizon. This plan may include strategies for budgeting, saving, investing, tax planning, and insurance coverage. When choosing a financial advisor, look for someone who is qualified, experienced, and trustworthy. Consider advisors who are certified financial planners, CFPs, or hold other reputable credentials. Ask for referrals from friends, family, or colleagues, and interview potential advisors to ensure they understand your financial objectives and can communicate effectively with you. Even if you're comfortable managing your day-to-day finances, consulting a financial advisor periodically can offer peace of mind and ensure you're on track to meet your long-term financial goals. They can provide an objective perspective, help you navigate economic uncertainties, and adjust your financial strategy as needed. Remember, investing in professional advice today can lead to greater financial security and success tomorrow. Thank you for joining me today as we explored these 15 money habits that could be keeping you poor. By recognizing these habits and taking proactive steps to change them, you can make significant strides towards financial freedom and a more secure future. Which of these habits resonated with you the most? Let me know in the comments below. Don't forget to like this video, subscribe to our channel, and ring the bell icon so you never miss out on our latest content. Until next time, take care and happy saving.